Now the question is, because it's a very critical week, and what to do in a scenario like this with investments? How are global investors thinking about it as well? Arvind Chari, CIO of Q India, invests money in India, talks to global guys, looks at the macros very closely. So all of this put together, Arvind, good having you. Though it would have been better if you are in India that you should have been in the studios, Arvind. I have that complaint.
I wrote to you. I told you I'm in India in Feb, and we never figured out a time. But
Okay.
happy to do this anytime for you, Neeraj.
I know. No, but anyways, Arvind, so good morning to you, I guess, from where you are right now. Critical week, Arvind, right? I mean, what is your base assumption? I mean, assuming that there is, because India and US are talking, trying to do some bit of a deal, whether it happens now or later, but if the tariff outcome on India versus the US, or India and the US, is not the worst case assumption, and is, let's assume, I'm saying that, let's assume the best outcome happens, what happens in such a scenario to risk assets? Because I would presume that the tariff war would have some impact on global markets by and large. So even if India's outcome is positive, does India do well, or does a global pullback drag everything lower? What is your base assumption?
Interesting. Can I pull it back from? I'll speak about India and
Yes,
Trump
yes,
and
yes,
tariff.
yes.
But there is a very interesting global trend that has happened, and it's been in the talks for the last 4 5 months, which is, so when we used to go, and we still go and meet, when we meet investors and we talk to them about Indian public equities and the beautiful long-term ride that it has been, and it looks like it'll continue to be over a long period of time. The common refrain that we get is, we love the story, we like the opportunity, but we do not do single country allocations. We don't take single country risks. And here we are today, many investors are finding and scratching their heads saying that there is a very large single country allocation in their portfolios, which is the United States. It's not only from American institutions, American individuals, but global investors are heavily invested into the US markets. And it's been a phenomenal run. I mean, US companies have been on the surge of tech and innovation, and that has done very, very well. And today you are in a situation where US is more than 60% of the MSCI World Index, or MSCI All Country World Index, ACWI as we call it, and it's a sizable allocation in any portfolio. And when we ask them now, saying that, do you think about US as a large exposure and single country risk? And of course, everybody is squirming, the chairs keep moving, the hands keep shaking, and in the sense that they are thinking about it, we don't know what is the outcome. But we can at least tell from our interactions that many investors, both in the US and outside, are thinking about how to think about it. And it is sizable, Neeraj. Foreign investors own about $40 trillion of US assets. About 31 trillion dollars is public markets, equity and debt. About equity is about 17 trillion and debt is about 14 trillion. And the rest is private capital. About 7 8 trillion dollars of money is in private US assets. And I'm not even counting about real estate that foreigners own in the US, right? Canadians own a lot of real estate in Florida and Texas to get away from the cold, and so are Europeans. So there is sizable amount of money invested in the US markets. And the way to think about it is, will, even if 10% of this allocation of 40 trillion moves away from the US and looks for home country or other shows, that's about $4 trillion. And the question that we should be asking is, can India get, say, 5% of that allocation? So about $200 billion of inflows. And this is the global picture that we are seeing. And it looks like this is probable. I don't know whether it will be 5%, 10%, whether it will be 20%, whether it will be nothing. But these are the conversations that most investment committees and most investors will be having. And India is fair play in that, because India has two very large things going for it. A, it has the absorptive capacity. Indian markets, equity market cap is four and a half, $5 trillion. Bond market is about $2.5 trillion. The Indian FDI, private equity, venture space is fairly large to absorb capital. And the second thing going for India is that India is by far the only friendly country in a scenario where there is risk. And the risk is not market volatility and standard deviation, and they are risk, but the risk is about geopolitics. The risk is about your assets being taken away, or you having tax or tariffs. In that, you would want to associate yourself with friendly countries who will treat capital in a fair manner. And India has absorptive capacity, and this notion of friendly capital. Now, if you have follow up on that, otherwise I'll take on the Trump question. But this is the background and scenario that we should be seeing, and this will play out over the next one to 2 years.
So
for
actually,
sure.
okay, let me rephrase my questions, Arvind, since you've moved
Yeah,
down that path, right? And which is this,
yeah,
that if indeed all of this tariff and other conversations bring
yeah,
about a steady weakness in DXY over
yeah.
a period of the next 2 or 3 years. Let's assume you build that
Yes,
out, or let's assume I'm building that as a hypothesis.
yeah,
Could it well be happen that we might see a good run in other emerging markets, even if the US markets were to suffer? US doesn't do well, the mother market is not doing well, it is catching a
right.
cold or it is sneezing, but the rest of the markets are not catching cold. Can Indian markets do well even if a US market is not doing well over the course of the next 24 months, cumulative?
You just go back to the decade of 2000. You saw that the DXY was depreciating. The US assets didn't do well, or US equities didn't do well. US businesses were doing well. And emerging markets had a big rally, and India actually did better than or almost as good as the other large emerging market countries. So India has done well in the last decade when US has done well and other emerging market countries have not done well, and India has done well or as much as other emerging market nations in the previous decade. So the Indian story, as we know, is a very simple story of 6.5% real GDP, double-digit nominal GDP, and then that gets reflected in equity markets. And I don't see that is changing. It's not that we are growing at 8, or it's not that we are growing at 4, right? We are still growing at a steady pace of 6.5, and that has delivered over a long period of time. So from that perspective, I don't think that should be any concern from a long-term perspective. In the short term, as you spoke about, Trump and tariff, I think India should be very careful in terms of not exposing their services to tariffs, because that is a bigger export that we make, especially to the US. I think 50-60% of India's software services exports or GCC exports are going into the US. So if that is away from Trump's eyes, and on the goods, I think India might be able to do a good deal with the US in terms of, say, buying oil as compared to buying oil from Russia, or allowing certain high value US imports to come in, like Harley Davidsons or the EVs to come in, at the same time getting some more concessions on trying to get some more exports into the US. If you are able to do something like that, we haven't heard anything from the government yet. But if you're able to do something like that, I think we should be able to deal with the situation reasonably well.
Point taken, Arvind. This is Harsh Saita also joining in. I want to quickly take a step back, Arvind, and ask you that if $200 billion hypothetically were to come to India,
Yeah.
what are the pockets that they'd buy first?
So if you look at the allocation pattern of foreign investors, at least up until now, if I look at the last 20 years, 2x more money has gone into private markets, so private equity, venture, real estate, infrastructure, and half of that has come to public markets. So even if you assume half goes to private markets, 100 billion comes to Indian markets. So that will get split into, say, public equities and fixed income, because fixed income also, we are part of the bond index. And as Neeraj said, if the expectation is that the dollar will depreciate, you tend to get more allocations to emerging markets, and emerging markets, what we call local currencies. Investors are willing to take on the currency risk of emerging markets as well. So you'll see some allocations, and broadly, we still feel that India is under allocated. Like India's weight in MSCI ACWI is about 2%, right? India's weight in global market cap is about 4%. If I look at overall global portfolios, I think less than 1% of global portfolios are invested in India. So there is a lot of scope, as I said, from absorptive capacity. And what they will buy, it depends on whether they track a passive index, or they give allocate to active managers like us in terms of how we build portfolios. But we have seen some amount of broadening of foreign ownership. Like 10 years back, 95% would have been in the top 50, 60 stocks. Today, we have seen it broadening out to about 100, 150 stocks. So, that overall space of, as the liquidity and the depth of the market changes, you're seeing those allocations happening. So, I can't make a guess of what they'll end up buying and what sectors they'll buy. But it will be a broad-based allocation, because these are global investors who do not have India, and they're making an allocation. and their objective should be to try and protect the risk. They know they'll get the returns and they can deal with market volatility, but the risk of liquidity, the risk of governance, and the risk of valuations in India, if they're able to protect those three aspects, then they will make a fairly long sustained allocation.
Point taken. And with all that's happening globally, Arvind, would be great to understand your view with regard to demand for Indian IT. There's so much happening in geopolitics. There's so much happening with regard to the macro as well, where rates are going to go.
Yeah.
And therefore, how should one view demand for Indian IT? And what could those other pockets be in terms of export potential or possibilities? What could those opportunities be like?
So in IT, generally we've seen when there is a scare of global recession, and we are seeing signs and shades of that, you tend to get an expectation that global IT spends will initially reduce, and then it picks up. The other way to think about IT is AI in terms of disruptions of AI and the ability to implement AI. But we saw that in the digital space. If you go back 7-8 years, the entire mantra was digitalization, and there was a scare on Indian IT services and GCC saying that they will miss out, and they will not be able to take care of the digital aspect, digital movements in global IT spends. And we realized that the Infosys and the TCS or the GCCs of the world were the ones who are implementing digitalization in across global companies and global IT spends. Something similar should happen with AI. There is a tool of AI, and the AI has to be implemented and used in different organizations. So the hope is that that aspect remains with the IT companies or the GCC spends that global companies do in India. I think that should remain. The other aspect, as I said, is the friendly aspect of India being friendly to different nations, right? US, India can have a good deal with the US, with good deal with the EU, and can have a good deal with some of the other Asian economies. And that aspect of whether PLIs or some export opportunity or China plus one has not played out in India. But if that movement continues to happen, where people are able to offshore to India and India can export, we'll see how it goes. But there are a lot of opportunities, and especially given India's place in the geopolitical sphere, I think it is for us to lose this opportunity. I think policymakers and regulations and corporates should be out in the front to be able to take market share away and benefit out of this opportunity that is coming through India's way.
Let's wait and watch if they do. But Arvind, maybe in the near future, once there is some clarity around these tariffs and the resultant moves, it'd be lovely to do a conversation again if you have the time.
Absolutely. Yeah. Anytime for you.
But thank you. And thank you so much for joining in today and giving us your thoughts. Really appreciate it.
Thank you so much.
Thanks, somebody sits in London, perched in the right area, speaks to multiple global investors, giving us a sense of how people might be thinking about it. How is he thinking about it?